Let's turn now to chips. Needham calling Nvidia the top pick for 2023, while Cowen goes with Applied Materials for their best semi-cap idea in the year ahead. They both got analysts, and they're both with us this morning. Joining us now to discuss those calls, Cowen's Krish Sankar and Needham's Raj Gill. Welcome to both of you. Let's start. Where are we going to start? With you, Krish. Tell me about the trade-off as you see it between equipment versus a best-of-breed chip player, and which way investors should bet more.
Sure. Hey, John, thanks for having me. Since I cover equipment, like you mentioned, our focus has been more on applied materials. First and foremost, I would say when I look at my front-end equipment coverage, the large cap names, whether it's applied materials, Lam Research, ASML, KLA, these are all high-quality companies. And these are all high-quality names. They're going to be extremely valuable over the next several years, especially as semiconductors become much more important. Now, when you look into next year, clearly the industry is going through a digestion, but the stocks are already discounting them. So when you look to the other side of it, especially whether you're in a recession camp or modest recession camp, investors do tend to gravitate towards companies that have a deep moat. Semiconductor equipment companies do have that. And within that, our preference is AMAT. But like I mentioned earlier, many of these names that I highlighted earlier are high-quality names, but into next year, we like AMAT the most.
So, Rajvindra, let me turn over to you, talking about Nvidia. You mentioned that's your pick based on the strong balance sheet, but I was looking at the last earnings, and I'd like to know what you're really keying in on here. When I look at margin, that was a miss. When I look at operating income, that was a miss. And even cash from operations, a huge miss. So what's so strong in this balance sheet that should give investors encouragement when, of course, there's weakness in data centers, there's weakness in gaming?
Well, the balance sheet is just one aspect of Nvidia. I think the bigger issue is that Nvidia experienced the kind of trifecta of hardships this year. There was a cryptocurrency collapse. There was an impact on the gaming revenue related to slowdown in China. They obviously were impacted by the export controls in China that prevented them from selling high-end GPUs. So there was a combination of events that had a negative impact on their fundamentals and also on the stock price. So as we go into calendar 23, a lot of those headwinds are going to turn into tailwinds. And with respect to gaming specifically, the gaming segment has been clearing out. They've been clearing out a lot of the excess inventory that's been built into the distribution channel this entire year. So Nvidia has been under shipping demand in order to clear out the excess inventory. We're going to reach a bottom in Q1, and then we are going to start to see a rebuild of gaming, upgrading to their latest architecture.
Okay,
the data center side is an upgrade cycle going on with their latest architecture as well. So a lot of the headwinds are now turning to tailwinds.
So Krish, I can see where you're coming from, at least in the long-term argument that equipment is going to be important because there's all this demand. Whatever's happening in China, eventually that equipment's got to go somewhere because the world needs chips. But Applied Materials was as low as 75. Now it's up near 100. And we're getting into this oversupply situation. Is it possible that in the beginning of 23, we end up with a situation where the stock goes back down there if the economy heads into somewhat of a significant recession?
Sure, I think it's a very valid question, and that's one of the things that's been on top of mind of the investors, right? And John, to your point, it was 75 in mid-October. Now it's around 104. I would argue the other way around and say if it was actually 165 in January, and it's corrected quite a lot in anticipation of a down cycle next year. The bigger question to your point is, could we retest the lows? I do think it is possible, especially if you are going into a deep recession, but the market is already discounting a weakness in spending next year. So if you look past into 2024, and you see some of a relative growth in 2024 from 2023, I think that's going to be positive for the stock. But largely, China weakness, a cyclical downturn is actually in the stock. Maybe a deep recession is not.
Well, Krish, really quick, I want to push back on you. You said China weakness is factored into your call, and Rajvindra, maybe it's in yours. But with the news that we have today, with COVID possibly being even worse than we ever suspected, hard to imagine you already factored that in. How much more of a downside risk is in just China, COVID continuing, and those lockdowns continuing into the new year?
Fair enough. I would say from an equipment standpoint, that's more like a second or third order effect because the equipment companies sell to the Chinese fab manufacturers, and that weakness is discounted. Eventually, to your point, if there's COVID shutdowns going to impact end demand in China, it'll probably filter through over a time, but it's not going to impact semi-equipment companies right away. It might impact more the end chip supplier or the end product seller into the Chinese market. But from an equipment standpoint, it's more the export controls that kind of went into effect in October. U.S. kind of like put, SMIC, a few other Chinese companies on export control or entity list to prevent them from getting access to the latest, greatest technologies through
Right.
U.S.
Okay, well, we got to leave it there. Krish, Raj, thank you.
Thank you.
Thank you.